Namaste and welcome to our Money, Mind and Markets, the science of financial literacy. The week 6, the future of finance, we'll discuss about the cultural attitudes towards the money. Let me ask you a question. What is a money script in your family? Is money associated with security or freedom? The evolution of Indian household finance represents one of the most significant structural transformations in the global emerging market landscape. Historically, wealth in India was synonymous with tangible, visible security like gold, CD we call it as, held in the ancestral chests or the land parcels demarcated by lineage and the fixed deposits, offering the psychological comfort of a government guarantee. However, as the Indian economy transitions towards a target of $30 trillion by 2047, the domestic financial side is navigating a volatile bridge between the traditional safety and the capital market growth. So, this topic, this lecture serves as a foundational analysis for the course, the Money, Mind and Markets, the science of financial literacy about the cultural attitudes, synthesizing the historical, sociological and the psychological dimensions of the Indian money attitudes to address the pervasive behavioral biases. Let us understand the segment 1. I call it as a psychology of the big fat Indian wedding. I hope you can recall it, right? So, we address the $130 billion elephant in the room called as a wedding. Let me ask you one question. Why does a middle class family spend 70% of their wealth on a single event? Let us explore the comparison bias and the signaling value of the weddings in a status conscious society. Let us understand the concept of the opportunity cost. If the 25 lakh wedding budget was instead invested in an index fund for 20 years, it would have created a retirement corpus of over 2 crore rupees. Let us understand the trajectory of the historical trajectory of wealth perception in India to begin with. The Indian relationship with money is not a merely product of modern economic policy, but is deeply rooted in a historical continuum that spans millennia. From ancient Vedic traditions, where gold was revered as a symbol of divine affiliation and spiritual prosperity, to the Mughal era, where intricate jewelry defined the social hierarchy and elite status, the tangible assets have always been the primary stories of value. In the first unit, we have discussed about the monetary value. During the colonial period, the introduction of a formal banking system and standardized currency began to alter the traditional trading practices. Yet, gold remained the preferred hedge against the political and economic uncertainty. The liberalization of the economy in the 1991 marked the first major structural pivot, introducing the households to the market-linked instruments beyond the traditional safe trinity of gold, real estate and the bank deposits. Initially, adoption was hampered by the perception of equity markets as speculative gambling, a view that has been reinforced by the Harshad Mehta scam in 1992, which served as a generational anchor for risk aversion. It was only with the advent of the digital revolution, characterized by the Indian stack, UPI and eKYC, that retail participation began to democratize. Today, wealth creation is no longer restricted to financial traders, but it is also for the middle class families who are increasingly utilizing the systematic investment plans, SIPs, to participate in the India's growth story. Let us understand the historical period, the primary wealth driver and the person of risk. I shared one table with you. In this table, let us see from the ancient, the Mughals. Initially, the gold, the land, the coins were the currencies. and there is a risk of physical theft or exploitation. Moving on to the colonial era where we have the formal banking system, the jewelry is one of the important parameters, whereas there is a lot of currency instability and the distrust of institutions. Coming back to the pre-1991, which we call the socialist era, we have used the products, the instruments like the fixed deposits, post office savings. But the risk is of high inflation and the limited options. And post 1991, the liberalization period has seen the financial instruments like mutual funds, the equities, the emerging markets, especially Indian market post Harshad Mehta is viewed as a gambling. But post 2015, that means the present digital world, we see the financial instruments of the SIPs, the digital gold, future and options trading. The risk existing is a systemic risk as well as the FOMO, fear of missing out, and the latest one being the influencers risk, right? So the transition from the physical to the financial assets to the financial assets is evident in the record growth of the mutual fund industry, where assets under management surged from 12 lakh crore in 2015 to 67 lakh crore by January 2025. This shift underscores a broader transformation in Indian society that increasingly values the informed decision making and long-term wealth compounding over the mere hoarding of the physical metal. Let us understand the sociology of the financial decision making now. We all recall the joint families, the patriarchy. The Hindu joint family system has traditionally functioned as an indigenous social security network, pooling the financial resources and sharing the business responsibilities across generations. Within this structure, the Karta, typically the eldest male, holds absolute authority over the investment decisions, the property management, and the welfare of all the members. This centralized authority often prioritized collective security over individual risk-taking, reinforcing a cultural preference for low volatility assets like real estate and bank deposits. However, the rapid nuclearization of families, that means the nuclear families, with the advent of the nuclear families in the urban areas driven by the economic migration or the professional aspirations, has reshaped these power dynamics. Younger, dual career couples are renegotiating the financial autonomy, moving away from the Karta-led model towards the consultative and independent decision making. This demographic shift is a primary catalyst for the increasing risk appetite seen in the urban retail markets or urban retail investors. Despite these changes, patriarchal norms persist. Studies have indicated that women are increasingly participating in the wealth creation, with women mutual fund assets under management doubling to 11.25 lakh crore by 2024. The women remain focused on safety instruments while men pursue the higher risk opportunities. Now, the following table gives to understand the family structure, decision making unit, and the investment philosophy as the parameters. To begin with, the traditional joint family, where Karta, the eldest male, the philosophy being the collective security and intergenerational land. And coming to the extended family, which we are also called as a consultative or multi-generational, there is something called as mixed view, that is the stability plus conservative growth philosophy. And the third one is a nuclear urban family, where we have individual or spousal decision making, and the perspective being the entirely driven by the goal based or market linked with high risk factor perspective. the psychological fallout of this transition is very, very significant. In patriarchal settings, the person responsible for the household's financial well-being tends to be more cautious, whereas those with greater decision-making power but fewer immediate dependencies exhibit higher risk-taking. As the joint family disintegrates, the private insurance provided by the collective is lost, so necessitating a higher level of individual financial literacy and formal insurance adoption. That's why this course tries to address that financial literacy gap. Moving on to the cultural consumption, the economics of the big fat Indian weddings story. Perhaps the most potent cultural force in Indian household finance is the wedding industry. Let me give you some glaring statistics. Indian wedding industry is currently valued at approximately $130 billion. That means 10 lakh crore rupees. So, for the Indian middle class, a wedding is not merely a ritual but a primary vehicle for social status, signaling and the capital expenditure. Statistics indicate that families frequently spend 60% to 70% of their accumulated wealth on a single wedding, often involving the liquidation of gold, fixed deposits, or even the ancestral property. This phenomenon is fueled by a social virus, which is very contagious, right? Comparison among the members, and moreover it is amplified by the Bollywood aesthetics and the social media platforms. So, the fear of being shamed or excluded from the community for failing to meet the standards compels the families to host the ceremonies that are disproportionate to their annual income. Let me spread you the table for you, spreadsheet, wedding, the statistics and the implication. The market size has grown the $130 billion. As I said earlier, it is the second largest consumption segment after the food. And the household wealth, it is drained to 60 to 70% of the total assets, with a severe depletion of the retirement corpus. Then comes the loan application, 20% for the ages 20 to 30 are wedding related. This leads to the debt trap for early career professionals. And then another important factor is the urban spend range, 15 lakhs to the 25 lakhs. This is a significant opportunity cost for compounding. So, the long-term economic damage is substantial viewing these figures. Capital that could have been directed towards the business formation, towards the startup, the higher education or retirement compounding is instead spent on high frequency and the short-term consumption like decoration and catering for the wedding purposes. Imagine a middle class family spending 30 lakh rupees on a wedding sacrifices a sum that could have grown to 2 to 3 crore rupees over 20 years if they have invested in equity markets. This misallocation of capital remains a primary barrier to the long-term wealth performance for millions of Indian households. Now, moving on to the segment 2, identifying the behavioral traps. We define the key biases, behavioral traps using the case studies. As we all recall, the herd mentality, the story of the Harshad Mehta bull run and the subsequent crash. And then here is a loss aversion. Why should we hold on to a stock that has fallen 50% because we believe that it will surely rise up? So, even when the company fundamentals are weak. Then comes the mental accounting. How the kitty party culture represents an informal but inefficient way to save. Let us understand these behavioral biases in the Indian investor landscape. If we look at it in our course, the money, mind and markets, the behavioral finance posits that the investors are not purely rational actors but are susceptible to the cognitive shortcuts which we call them as heuristics, and the emotional triggers, which are discussed in the week 2. In India, these biases manifest in specific cultural ways that frequently led to suboptimal financial outcomes. If you look at it, the herd mentality and the FOMO cycle, herd behavior, the tendency to mimic the actions of the majority is pervasive in the Indian stock market. This was widely demonstrated during the Harshad Mehta speculative frenzy of 1992 and more recently during the post-pandemic IPO rush for companies like Paytm and Zomato. Younger investors influenced by the social media, so-called as the fin influencers, often enter the market during the peak bull cycles due to the fear of missing out, FOMO, only to be panic and sell during the inevitable corrections. And then we have the loss aversion and the disposition effect. Indian retail investors exhibit a strong disposition effect, the tendency to sell the profitable investments, we call it as a winning stock, too early while holding on to the declining assets, which we refer them as losses, for far too long. This is rooted in the loss aversion, the psychological reality that the pain of a loss is twice intense as the joy of an equivalent gain. This behavior is particularly evident in the real estate sector, where sellers anchor their valuations to past peak prices and refuse to sell during the downturns, even when fundamentals suggest the continued decline in the property prices. And then comes some mental accounting and informal savings. The habit of compartmentalizing the money based on its source is a hallmark of the Indian financial psyche. Families treat hard-earned salary money with extreme caution, like parking it in fixed deposits or treating the windfalls like bonuses or lottery winning as extra money and cater to the high risk or speculative trading. This bias is also seen in the popularity of the kitty parties, isn't it? The informal rotation saving associations, where women pool cash for social and household needs. While kitty parties provide a safe space and a mechanism for forced savings, they lack the transparency and the regulation, and the cash corpus often fails to outpace the inflation because it remains outside even now at this juncture from the formal banking system. Now let us move to the third part, the segment, the science of financial literacy. We shift to the solutions. How do we solve these behavioral, cultural, behavioral finance issues? The power of the SAP, systematic investment plans. These acts as a behavioral shield. By automating investments, we remove the fear and the greed, the two emotions of the market, and try to time the market. The fear and greed index will help us. Next comes the ACE framework, ACE, attentiveness, that means setting the benchmarks, commitment, sticking to the plan, and empathy, understanding our own emotional struggles. This is called as an ACE setup. Then another strategy is the mathematics of compounding to show the impact of the time, the opportunity cost. So, the compounding effect is the eighth wonder. So, we demonstrate how starting at the age 25 versus age 35 changes the final wealth outcome by crores of rupees. And then comes the fin influencer phenomenon. And the digital transformation has introduced a new player into the financial ecosystem called as a fin influencer, one who influences our financial decisions using technology as a platform. These social media personalities simplify the complex concepts through the YouTube, Instagram and LinkedIn, making the financial learning accessible to the Gen Z and the millennials. However, a lack of regulation creates a significant risk of the misinformation. Research has indicated that only 2% of the influencers are registered with the SEBI, yet 33% provide explicit stock recommendations. The reliance on these digital figures often exacerbates the overconfidence bias, where novice investors believe they possess superior market timing skills based on the bite-sized video tips from the free influencers. This has directly contributed to the surge in the retail participation in the high-risk futures and options segment, where more than 89% of participants have suffered net losses in financial year 2023. I'll share some of the statistics with you, the influencer metric, the data point, and the SEBI registration date. With 2%, the recommendations of 33%, and the content consumption has been made by the young investors who 75% consume this daily. So, what is the impact on the trading? The frequency? It's a strong positive predictor. So, this is the risk of the financial influencers in the digital financial world. Next, moving on to the asset class realities. Gold versus equity versus real estate. A core component of financial literacy in the Indian context is demystifying the returns of the traditional versus the modern assets. For decades, the headline returns of the gold in India have sustained its cultural status. Over the 20-year period of 2025, the gold has delivered a compounded annual growth rate (CAGR) of approximately 15% in rupee terms. However, this victory is incomplete without examining its drivers. The strong performance of gold in India is heavily influenced by two factors. The first one being the currency tailwinds. The Indian rupee depreciated by approximately 50% against the US dollar over the same period, from 43 rupees 2020 to 2002 2025 rupees 84, from 43 rupees to the 84 rupees. Since gold is globally priced in dollars, Indian investors received a structural boost that has nothing to do with the gold's merit as a productive asset. Then the second driver is the portfolio stabilization. In periods of the extreme stress such as the 2008 crash or the 2020 pandemic, gold prices surged as equities plummeted, making it an excellent diversifier but a poor primary wealth engine. The below table makes you understand the asset class and their returns for the 20-year and their compounded annual growth rate. The gold with a 15% CAGR, it has increased to the 1.64, whereas the Nifty 50 TRA, the equity has been 14% with a value of 1.37 crore. The real estate, the urban average is 7.8% with 45 lakhs, and the fixed deposits with 7% with the 39 lakhs. Please make a note. In my extensive research of the study, the gold has shown the higher terminal value here, rolling to 10-year windows of 2014 to 2024 that has diversified the equity funds averaging 12% versus the gold's 10.6%. Furthermore, the making charges on the physical jewelry that costs around 8 to 25% means the investor starts deep in the rate, requiring a significant price rise just to break even. That's the reason we have these modern financial literacy programs that emphasize that while the gold predicts, the equities compound. So, this lecture opens with the narrative of the steel cupboard, the quintessential Indian household safe, right? So, parents and grandparents, wealth was a physical thing. If you couldn't touch it, it wasn't real. So you should understand that this was a rational response to an era of limited banking and high uncertainty. But today, if we look at it, we live in the era of the digital wallet. The challenge for the modern Indian investor is to transform from hoarding to allocating. I will share you the Indian Wealth Dashboard scenario wherein we see the current state 77% of Indian wealth is in the real estate, 11% in gold and less than 5% in the financial assets. There exists a literacy gap too. Only 27% of Indian adults are financially literate. And comes the derivatives danger. As I said earlier, because of the Indian influencer, 89%, most of the investors are using either F&O and 89% of the investors lost in the F&O money. Now let us understand the comparison virus, the checklist for that. Before committing to the major status spending like weddings or the luxury cars, ask, am I doing this for my joy or to avoid shame in the community? What is the 20-year opportunity cost of this amount in a 12% compounding annual growth rate fund? Is this being funded by hard assets, that means selling gold, or future debt, means borrowing using the personal loans? So this is a contamination virus checklist to answer our cultural attitude of the money. Next, we will try to address the behavioral bias that exists because of the cultural attitude. Are you a herder? Did you buy a stock because a YouTuber or the Fin influencer recommended it? Do you suffer from the disposition effect? Do you have a red portfolio full of losers which you refuse to sell? Is mental accounting hurting you? Do you treat your bonus as play money while your home loan interest is at 9% which you are paying the EMIs? This will answer our behavioral biases. Let us also understand the traditional versus the modern comparison of these real assets. The physical gold has making charges up to 25% with GST of 3% also has a storage risk. From musical gold to the move on to the sovereign gold bonds SGBs, there are no making charges but with 2.5% annual interest and they are tax free at maturity. Then comes the asset, the real estate, where we have the average return of 7.8% but has a risk of low liquidity. And then comes the equity SAP with an average return of 12 to 14%, high liquidity and disciplined compounding. Let me try to address the Fin influencer fact list here. So before following social media advice, just find out whether the Fin influencer is the person SEBI registered. Do they show their full portfolio or just the winning screenshots? Are they disclosing their sponsorships? So you need to be aware of this Fin influencer risk in financial markets. Let us understand SIP power plan. From our initial sessions, we are saying that automation, set the date so you won't forget it. Next comes the discipline, buy through the dips and the peaks. And the time element, start now, just to do it. So every year your weight reduces your terminal wealth by approximately 10 to 15%. Most importantly, do the kitty party audit, especially in informal finance. The social value, the connection, the support and friendship has to be channelized and has to be audited so that there won't be any financial risk because these are not regulated. There is no insurance benefit and this cannot be compounding. So the kitty party financial risk has to be addressed. of all the challenges, let me suggest you one hybrid solution. Use the kitty for the social bonding, but move the savings corpus into a liquid mutual fund or SIP. Does it work better? Yes. Let me make you to understand with some reflection question. If your parents spend 30 lakh rupees on your wedding, would you rather have that money as a down payment for a home or a starting investment for your child? Try to answer these questions by reflecting. Coming back to the action, I request you to identify one loser in your portfolio and research its fundamentals. Decide if you are holding that stock, that asset, is it due to the loss aversion? To conclude, the path towards a wealthy Bharat. The Indian cultural attitude toward money is always at the crossroads. The traditional reliance on the physical sona, the gold, and the jameen, the land, provided a bedrock of security for generations to generations. But it is insufficient to meet the aspirations of a modern globalized economy. The big fat Indian wedding remains a significant drain on household capital, fueled by the psychological trap of social comparison, contagious virus. Not only that, meanwhile, the rise of the digital influencer offers democratized knowledge but introduced new risks of speculative mania and overconfidence. So, the solution lies in a robust, behavioral informed financial literacy framework. By leveraging tools like the SIP that automates discipline and the ACE framework that encourages the empathy and benchmarks the Indian investors, I hope we can overcome the biases like the loss aversion and the herd mentality. The goal, the objective of this course, the money-minded markets, is to transform the Indian household from a group of hoarders of physical assets into a sophisticated class of allocators of productive capital. Only then can the true potential of India's demographic dividend is realized, ensuring that the journey toward a $30 trillion economy is anchored in the financial well-being of each and every household. Learners, are you fit? Finances, fitness, earn, save, invest and retire. Happy learning!